Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to introduce you to today's event, Managing Credit Portfolios in the Current Volatile Environment. Throughout the panel, you may post any questions you have using the Q&A function at the bottom of the screen. Questions will be answered at the end of the event. Next slide, please. I'd like to tell you about some upcoming events that you may be interested in. We're finishing our weekend seminars this week. On December 9th is the final workshop for coding for risk management. On December 10th is the final workshop for IQRM and our Intro to Finance seminars. All three of those seminars will begin again in the spring. Also in the spring, on January 18th, we have our featured alumni series. On February 8th, we have a panel on the rapid rise in U.S. interest rates. And on March 7th is our CRO Spotlight featuring Simeon Fishman. Next slide, please. And now I'd like to introduce the moderator of today's event, Chris Jusiotis. Chris.
Hello, everyone. Thank you for attending. Thanks for the panel. Thank you, Jay, for introducing. I just want to, I know some of you might have seen me around. I've been at Columbia University's ERM program for the last 3 years now. I have the privilege today to moderate a very great subject given the volatility in the markets and great panelists. A little bit about myself. I'm a veteran, 30 years price blanker. Actually, believe it or not, I started out of school on October 19, 1987. And if you Google that day, that's the day it is called Black Monday, when the Dow actually dropped 20%. So that's the day I was introduced to Wall Street. I worked at the banks the last 30 years, and in between Bank of America I started, and the last 20 years for Japanese banks. The last job I had as a banker, I was the head of the left fin, or leverage finance. We used to call it credit, strategic credit products group, which we cover all the middle market, large cap, which I'm going to explain later, those areas. And then I manage a CLO, which is the indirectly investing in the leverage finance business. On April of 2018, I told my Japanese management sayonara from banking, and I started actually concentrating on three things. First, teaching, which is my passion. I've been teaching now since then, different courses, especially finance and credit. I also been writing some books since then. I wrote 2 textbooks. I'm on my 3rd textbook now, and I also contributed to 3 other books in the areas of finance, credit, investments. The third thing I'm doing, I'm also an advisor to many of the VCs and private equity for particularly brand new companies. And I'm an interim CFO on some of the startups pre-seed companies. So I've been doing a lot lately, and in my privilege now to continue in my heart the last 30 years doing the credit analysis and introduce you some very interesting panelists here. So let's start with my good friend Paul Delova. Paul, if you can open your.
Yep.
Okay, thanks, Paul. Paul is he is the managing director and head of the portfolio manager at Sumitomo Mitsui Banking Corp. I was exactly there. I worked there for 10 years. I actually hired Paul. He's one of our star hires. When I hired Paul back in 2014, he started as the head of the portfolio for middle market, as our bank at the time moved into the middle market space from the large corporates. And since then, actually, Paul moved up as a managing director. He's the head of the portfolio manager for even larger cap. So he has more responsibilities, and he's a very good friend of mine, and I'm glad that he's here. The next panelist is my good friend Ken. Ken and I actually have about similar years in the business. He has been a success story for many of our senior people that started back in leverage finance back in the days. of Manny Hanny and Chase and JP Morgan. So he started in the large cap area. He moved into Indo-Suez, and I remember Indo-Suez was very big in the mezzanine area that we always needed at the time of leverage finance. And I know Ken have looked at the middle market business, has been underserved at the time. So he approached his manager at the time to start Churchill Asset Management. He's the co-founder and CEO of Churchill Asset Management, a very large $42 billion under management of left fin business. He's been success stories every year. I've seen Churchill winning all kinds of awards as the best lender this year and then last year. So we're very happy to have Ken on board to discuss this very important matter. Thank you, Ken. Welcome, Ken.
Thanks very much, Chris.
Thank you. So just to discuss a little bit, just put things in perspective, the subject today specifically is managing credit portfolios in the current volatile environment. Of course, we have two representatives, and they are perfect for this because Paul Delova, for example, he works for SMBC. SMBC is a regulated bank. Let me explain. A regulated bank is a bank like any commercial bank you guys see, where they have deposits behind it. And a regular bank has a lot of, they have to go through a lot of the, regulation, and they have a more restrictive. Of course, Paul has been also overviewing the large cap. Large cap is the so-called broadly syndicated loans, which we're going to discuss in a few minutes, which basically making leverage loans in much larger deals, and also does middle market. Ken, on the other hand, is actually he's part of a non-regular financial institution, non-regular by the OCC, of course. And so there is a different perspective, different risks, and different markets that they serve. But at the end of the day, they serve in the same asset class. So this is perfect to hear different perspectives, and I appreciate this, having them come in on board. Continue with the, just to give you a little bit of a background before we get into, dive into the panel. Of course, everybody have seen many negative news out there. We have high inflation hit all-time high. We have high interest rates as the Fed actually is trying to combat the high inflation. But then we have some mixed feelings. We have a great report, job report that came on Friday. So it's a lot of speculation out there what's going to happen. And this, these professionals that we have today can tell us how they view the things and how they manage through this volatility. Just to give you some perspective, again, going forward, as you can tell, this is a consumer index, price index, inflation CPI. It's been about 30-year high and it's coming down, but still a very high to historic perspective. The rates are going high, and this is the SOFR, which SOFR, I guess, is what the banks use as their index when they charge the customers plus some spread. We have the GDP, though, is not letting up. It's kind of, it had to two negatives a quarter. We're having a very positive quarter last quarter, and it's probably going to end up this year around less than 3%. But this economy is not letting up, even with the Fed actually pushing, try to soften the economy with all their tools that they use. Unemployment is still relatively low. And the recession, everybody, if you ask everyone in the industry, they expect a recession, a big portion, the majority. Looks like the signs are out there. And one thing that I learned over the years, what drives markets, the decisions today is the speculation, what's going to happen. So nobody has a clear understanding what's going to happen next year. So you tend to be more conservative, I guess. On the other hand, if you're in the right, asset class, maybe you can be aggressive. We'll discuss from our managers what it is. Now, who is investing in this asset class? Just to make sure that you guys understand what leverage loans are. You heard about equities, you heard about bonds. Leverage loans, another asset class within the debt market. It's mostly tend to be institutional investing, but every one of us in the retail can actually invest in it through indirectly through any funds. We have the regular banks actually lending money to this business, so they're investing in this business in leverage companies. And the leverage company is the one that has a little more debt and is rated by S&P and Moody's like a BB or below. We have the non-regular banks that Ken is representing, and the money behind those non-regular banks could be prime funds, could be pension funds, mutual funds that they allocate some capital under the alternative investments. We have the exchange trade funds, CLOs, which is a big area back in the early 2000 that they continue to invest heavily in the leverage finance business. And also you have by private investors, even the private equities, they're having vehicles to invest in that. If you look at this thing, this is the financial advisors allocation out there. And everybody knows about the equities, fixed income, and how much cash. What we have been seeing lately, the alternative investments here has been, gaining market share. There is a lot of attractiveness in this class. And I remember when I worked on this, when I was working in this class, actually presenting it, when I was bragging about it, it has the best Sharpe ratio for my students that know what Sharpe ratio is, which is the combination of return and rewards, and has been proven year on year. It is a good allocation, a good complementary asset class to have as a portfolio manager. Now, what's going on, of course, the prime funds have been heavily investing in the business. We see some slowdown the last few years, like anything, because of the speculation out there. CLOs also, you have seen some slowdown. They clip about 100 billion a year of new issuance. So CLOs actually slow down. Again, is wait and see attitude, I guess. And also the returns, overall returns, have some challenge in 2022, and the returns have been very good for this asset class. But the last year, 2022, was a challenging year for everything in this environment. If you look at this column I just put together, the third quarter was a very challenging quarter comparing to, like, in all categories. They have the refinancing of existing debt, existing deals got slowed down. Dividend recaps are like deals that you raise debt to pay dividends to private equity. Sponsor M&As are down. Sponsor deals are down. LBOs are down. So it is, I don't know if this is like the beginning of a lower, continual lower clip, or it's just an anomaly. We'll find out what we think going forward. Finishing off with the institutional loan, leverage loans. These are LBOs. Again, you see the lines here at the third quarter, they are lower than average. This is what I was mentioned before, the large cap or the BSL, broadly syndicated loans. They are been having a big clip. I look at the BSL. The BSLs have been having a big significant presence back then, but lately the non-BSL or middle market deals that both gentlemen are serving, they are picking up a lot of the market share, and the many reasons for that, but primarily the middle market are more control risk, if you will, and we can discuss that a little later. Single B plus is the sweet spot for leverage loans. That's why they call leverage loans as single B, and we have seen some actually, we have to dig to complete credits. The market's about 10% yields. I remember probably the highest yields I remember for many years now, but we're having a clip of, high yield type instrument, which it could be good and bad. It could be good for investors, but it could be bad for borrowers that they have to service those very high interest rate debt. This is the middle market space. The middle market space has been solid, and this is what Ken and Paul actually play in. And if you want to, like, we are a risk people, and I will be if I have to discuss what defaults, there are very low defaults on this business. We always average about 2% in our thesis, but defaults for those loans, even though they're single B, risky loans are below 1%, so they are in check. So it hasn't been any significant, even with COVID, that we've seen some increase in defaults here. That's COVID time. They came back to less than 1%. So not many of the borrowers actually have seen many defaults, even with the toughest pandemic we've seen in many years. And this is what the Ken's world is. They have a lot of dry powder. He's a direct lender and a private. So it's a lot of dry powder. He's going to talk about it for the next cycle to put up to work. and compete directly with other commercial banks, that they try to stay away a little bit from the business. And this is my last page, basically high yield bond, which is indirectly, but very specific for the large cap. The bond market, which is another complementary raise for any LBO, that has seen one of the worst years, in one of the worst quarters. And you can tell there's a lot of challenges. That's why the BSL business is not doing as well, because the bond market has been challenged the last year. And the private equity, which is the ultimate financing, like any deal, you have the loans, you have the bonds and the equity. Even the private equity now has been very challenging for them, even with high valuations one way, and I'll also try to find financing is challenging, but many opportunities you will see out of this, like anything. So with that, this is my last slide. We can dive into our panels. And we have our panelists. Thank you guys again for agreeing to come to this. You've seen some of the pages I put out. Let me start with both of you. And I want to find out from you, Paul, start with Paul and then Ken with the same question. You know, how do you see the markets now, given what's going on out there internally when you see deals now? How do you see the markets, and how do you manage with all this in your portfolio?
Yeah, thanks, Chris. You know, it's obviously been a very challenging period. You know, we've seen a lot of challenges since the second half of 2021. And, you know, the supply chain issues have just manifested themselves in different ways. Availability and cost of labor, higher energy and transportation costs, you know, particularly for any borrower that's sourcing from overseas, which a lot of our borrowers do. We've seen ocean freight go through the roof in the first half of this year. We've had so many challenges with availability of product for borrowers, and it's caused inventory levels to show a lot of volatility. We have a lot of borrowers carrying a lot more inventory than they normally would because they're worried about shortages, and they're dealing with demand challenges now as the inflationary aspects of the economy have heightened. You know, it's been a challenge to negotiate pass-throughs on costs for a lot of borrowers. And then we have rising interest rates, which in our middle market portfolio, that is pretty much 100% floating rate. In our large cap portfolio, there may be fixed rate bonds in the cap structure, so there's some insulation there. So it's been just a very challenging environment to manage through. And, you know, during these cycles, as you know, Chris, you know, more attention is spent on managing the portfolio and less time and energy, if you will, is focused on underwriting new transactions, and credit becomes, you know, a lot tighter in their credit decisions. So it's sort of a double-edged sword right now. So
thanks, Paul. What about Ken? How do you manage through this market volatility and the negative things going on out there?
Yeah. Sure. Well, you know, it's interesting, you know, if you look at, you know, our focus, which is, you know, exclusively on U.S. private middle market companies, you know, as a manager, we can and do elect to avoid some of the more volatile and challenged industries. So, for example, we don't invest in oil and gas. We don't invest in restaurants. We don't invest in traditional bricks and mortar retail. And we generally avoid businesses that have high levels of operational or financial cyclicality. So as a direct lender, we choose to focus on areas like software, healthcare, business services, industrial manufacturing, distribution, fundamental businesses that are generally more resistant to you know, more volatile and challenging markets. Now that's not to say we're immune from, you know, the challenges that companies are facing today, particularly in supply chain and obviously rising interest rates. But I would say as a direct lender, you know, we have the ability to very much to focus on areas that we feel are a more defensive industries, and ultimately companies that are generally lower levered, and you know, with financial covenants and significant equity, we've managed to weather current economic dynamic pretty well. In fact, we just finished our most recent portfolio review. Since we're on the topic of portfolios, we have today about 32 billion in both private debt and private equity. Private debt is about our private debt portfolio today, including both senior and junior debt, is about $20 billion. We have about 280 companies in the portfolio. We had all total roughly 5 upgrades in our portfolio and 3 downgrades across our portfolio. So, I would say so far so good, but I think we all recognize that, we are dealing with an unprecedented interest rate dynamic. We certainly underwrote these businesses with a sufficient coverage level that they should be able to withstand the higher cost of financing, since all of our loans are floating rate. The good news is, as an investor, you're earning, close to 11% today. The bad news is, as a company, you're paying close to 11% today. So, we like to focus on businesses that have the ability to withstand, a higher rate environment and dynamic. But that being said, it's certainly a more conservative underwriting environment today. All the direct lenders, and certainly ourselves, are being more selective about the companies that they finance, looking to finance businesses that, are proven to be able to withstand some of the challenges we're seeing in the current market environment. But I will say, given the fact that the broadly syndicated loan markets are generally closed to new issues, and obviously Paul would know this well, it is providing opportunities for direct lenders to step in and and finance some pretty attractive investment opportunities. So we're still seeing pretty good deal flow, but we're being more conservative. Obviously, overall leverage levels are lower because interest rates are requiring us to lever these businesses at a lower rate, just given the absolute cost of debt. We're certainly taking a very cautious approach to the industries and companies that we'll finance. But the market is definitely functioning, and I think it's a good example of how the private credit market in today's environment really steps in to fill a gap that that market really didn't exist in the GFC. And so I think that's a big difference between today and the GFC, where the banks were really the only game in town back in 2007, 2008. Today, you've got significant capital with the direct lenders, and certainly the largest of us are remaining quite active.
Yeah, thanks. I mean, just a follow-up question there, Ken, is I remember, I guess, in good markets, of course, the banks are a little more aggressive. They can give you a little more leverage. And in bad markets, actually, the swing, you swing to much lower leverage. Of course, now you have the interest rate environment, which was never a problem for many years. So it's like balancing the coverage and the leverage, if you will. Is anything has changed the last year in terms of the dynamics of the structure? More equity, less leverage? What is the kind of typical structure? Yeah.
So I would say in the current environment, we're seeing leverage levels in general come in a full turn. So a deal that got done, a year ago at 6 turns of leverage simply can't handle 6 turns of leverage anymore. Just the sheer cost of capital, the rate that a company would be paying, overall is driving leverage lower. And you couple that with a more conservative approach today, and I would say all but the very best companies are really the only ones in our view that can access fully the financing market. So lower leverage. I would say overall spreads today in the direct lending world are wider for a solid high quality credit that can issue, probably wider by 75 to 100 basis points. So a deal that a year ago was LIBOR 450 is probably LIBOR 550 or more, and so on. So I would say spreads are wider. And then obviously the biggest single difference is that the underlying base rate, the SOFR or LIBOR that we price our loans to, is up about 300 basis points from where it was earlier in the year. So a combination of wider spreads and significantly higher base rates is resulting in all-in yields today in the middle market close to 11%, actually above 10%. So higher cost of financing, wider spreads, higher ultimate base rates, lower leverage. And I would say that the covenant negotiations that a year ago maybe favored the borrower now favor the lender, meaning we get what we want. The one thing that I think is surprising about the current market that is maybe a couple of things. One is that deal activity remains quite robust in the middle market. You're still seeing quite a few deals get done. In fact, we as a firm, as a direct lender, are in the midst of what will be a record year of investment activity. And that's a little bit surprising. And purchase multiples today for very high quality businesses have actually remained quite high. So the average purchase multiple in our deals for the last quarter, for example, was 13 times cash flow. And people are surprised by that because they think, oh, well, the public markets are down. Does that mean the private markets are necessarily going to come down from a valuation standpoint? We've seen a little bit more conservatism, but I still think good companies are going for, relatively high multiples. And number two, I would say the other difference in the market is that because the broadly syndicated loan market is closed and the private market is really the only game in town today, deal flow, it's a wider runway, if you will, right? Historically, once a company got above sort of 100 million in cash flow, it would go to the syndicated loan market. Today, there is no option to do that. And so larger companies are accessing the direct market as opposed to the syndicated market. And the combination of those two is resulting in very good deal flow for direct lenders today. So we're still, quite active as we head into the end of the year.
It's interesting that the kind of the multiple, acquisition multiple is 13 times, but the debt multiple came down to 5 times. So
that's right.
The difference is made up. You could
Equity.
see deals more than 50% equity, right?
60,
More than
60% equity.
Or more than 50.
Our average, that's right. Yeah, our average equity contribution last quarter was 60% equity.
60% is amazing. And for the audience to know, the traditional leverage deals over the last 30 years, obviously, is this low equity, more debt, I guess. But it looks like, and it's almost like an investment grade, 60% equity with 40%. But because of the high interest rate and all the other stuff that we are witnessing, that pushes the equity to make the commitment, which is interesting, again, if the returns are there for them. But that's another discussion. Thank you.
So there's an interesting, one other point that I think will be interesting for the audience. So one of the things that we have tracked historically, and Paul, you guys may look at this as well, and it's a very interesting dynamic. We track something called the all-in yield per unit of leverage, right? So in other words, you have a company that's 4 times cash flow levered. What are you actually earning for the loan, right? So for example, if you were 4 times levered and you were earning 6% for your loan, which is historically about the place we were in, you were earning about 150 basis points per unit of leverage, right? So 4 turns of leverage, 6%,
Right.
150 basis points per turn of leverage. And historically, if you went back 10 years, that has been in the range of 150 to 175 basis points. Today, it's over 250 basis points.
Wow.
So a significant, 60 to 70% increase in what you could arguably use as a benchmark for risk-adjusted returns.
Right.
Not to mention better covenants, more equity, et cetera. So actually a very good time to be a direct lender if you have capital, if you have dry powder, and if you're careful and conservative about the kinds of companies that you finance.
I'm going to have Paul have a discussion there. Just for the audience to know what we discuss in leverage. It's a ratio of debt. You put a total debt on the numerator and EBITDA or cash flow in the denominator. So you try to find out how many turns of cash flow. it matches the debt. So that's the concept of leverage, I guess, for those that don't know. So if you look at an acquisition that somebody buys, 10 times EBITDA, you can have a debt capacity up to 6 times EBITDA in the traditional deal, and then the other 4 times has to be filled up with equity. So that's just a little academic discussion. Paul, on your side, have you seen some pressure now? Your credit committee has been, of course, working for a Japanese bank. They tend to be more conservative in nature.
Yeah.
Have you seen any stance how they view recession ahead of us, if they became a little more conservative in approving new deals? And it would be interesting to find out what the temperature out there for regulated banks as we're going through most likely a slowdown in the economy.
Yeah, I mean, we've definitely seen, I mean, we're still in business and we are seeing good flow in the middle market space, as Ken mentioned. But as you know, Chris, during these periods of time, credit becomes a little stricter on their rating standards in these kind of environments. So we are taking a more conservative approach. We are, managing through the portfolio. It is holding up well. But as I mentioned earlier, when you're spending a lot of time on managing existing accounts and you're managing downgrades in your portfolio to manage regulatory requirements on your ratings, it tends to lead to a heightened credit environment from your credit signers. So we're definitely experiencing that right now.
And on the regulation side, I guess, of the OCC looking over the shoulders, I remember when I was there managing after the 2008 fiasco of financial crisis, you got the OCCs all over the banks in terms of keeping a guidance of 6 times leverage. And we haven't heard back from them in a long time, the last 4 years. Are they back on your shoulder now and trying to make sure that the regular banks are staying within the guidance, or any new guidance?
Yeah, leverage loan guidance is front and center for my job function here. Yeah. And I think one of the differences in my product versus Ken's is Ken is not subject to a 50% debt repayment test that I have to demonstrate on my accounts to keep them as a regulatory pass, or when we underwrite the transaction. Ken can do a transaction that has a big second lien piece underneath it that may incur a lot of interest expense and take his debt repayment below that 50% threshold, and he's comfortable because he's got a turn and a half of junior debt in the cap structure, whereas I can't sell that to a regulator as being a pass credit. So it's an interesting dynamic that we both deal with.
Yeah, no, it is, and I would say that we are regulated as an asset manager.
Yes,
and we are regulated obviously as and our largest investor. We're an affiliate of Nuveen, which is the asset management arm of TIAA. So TIAA is our ultimate parent company, and they are regulated as a pension fund, but more importantly, as an insurance company under New York law. So TIAA is regulated by the insurance regulators. Nuveen and ultimately Churchill are regulated by the SEC. We're both a 40 Act manager of 40 Act funds, publicly registered funds, as well as private funds. And so we've got a fair amount of regulation, but it's a different type of regulation than the banks, right? And so I think in that sense, it's I would say it's designed more to focus on the transparency of our investment portfolios and the disclosure to our investors. But I would argue that the transition away from the banks over the last 20 years that Chris and Paul and all three of us have witnessed, I think is actually healthy, because I think what we've seen is that in a more disrupted environment, the private lenders, the direct lenders, institutionally backed private capital managers are there to provide capital in a more disrupted environment. So I think it's a good thing. I would argue that the size and scale of the direct lending market today, the private market, has served as a real buffer in some of these more challenging dynamics.
And I remember actually back in 2008, 9, because of we had a situation that the markets went away, that the debt markets, and then you have this step up, these direct lenders stepped up with unit tranches and other ways to get in so they can service the customer with both the junior debt, which is sometimes the junior debt has more volatility that we've seen, and the senior debt, which is the you guys are doing. So there is it's always, when you have recessions, when you have down markets, there's always a way to reinvent how you manage the market, how you manage the portfolio going forward. Right? So now, of course, how do you see any challenges or anything that we went from LIBOR, for everyone knows, London interbanking offering rate, to a SOFR, which is another setup because of LIBOR. As you can tell, LIBOR wasn't working. It's a lot of fixed rates. Have you seen any challenge? Would you change anything, the transition of LIBOR to SOFR? It's very technical and question, but Ken, what do you think?
So, I guess a couple things on that. One is that the private markets were much slower to transition to SOFR. The public markets, the banks were basically being required to move to SOFR. So all of the new issue activity in the syndicated, the large cap market, moved fairly quickly to SOFR because the regulators, the OCC, the Fed, they were pushing banks very hard to move to SOFR. So the private markets were much slower to move to SOFR. But where it started to have an impact was in the fact that the private markets were utilizing bank financing as a back levering or financing to their portfolios. So, for example, SMBC is a lender to Churchill, as an example, right?
Yes,
so they would lend capital to us, to our funds, and we would obviously deploy that as part of our leverage strategy in our overall funds. Pretty conservative leverage, but there is a modest amount utilized for middle market loans. So the fact that they were requiring their loans to be denominated in SOFR ultimately pushed the private lenders to ultimately denominate the underlying loans in SOFR as well. And so we found that starting in the first quarter of 2023, that transition actually accelerated, certainly for the largest managers that were utilizing financing. That was kind of driving them to move to SOFR. Another example is we have quite a few international investors who kind of look at the overall standard and say, no, our country or our regulator is requiring us to invest in SOFR-based loans. So it started to move more quickly in the first quarter of 2023, and I would say virtually all of the deals we're doing today are SOFR-backed. It took a while to get going, but I would say today everything is pretty much moving in SOFR.
What about you, Paul? Any
Yeah, I mean, I don't have a lot to add to what Ken said, but he's correct. Starting in 2020, we were mandated not to make any new LIBOR loans. So, the process is still ongoing. I guess there's still a lot of transactions that are LIBOR based that will need to be amended between now and June. The first step in the process, Chris, was introducing quote unquote hardwire language into credit agreements that mandated the terms around the SOFR conversion. As I mentioned, starting in January 1st of this year, the banks were not allowed to make any new dollars or extend maturities in anything other than SOFR. So still a bit of an ongoing process. And, our bank is a little concerned that there's going to be a mad scramble to fix all these transactions that were done pre-2021 that have not, moved over to SOFR. So it's going to be an interesting 7 months now, because SOFR is LIBOR is going to go away starting in June of next year.
Yeah, thank you. And just change the subject a little bit about ESG, and a lot of our students actually, they're always interested to read about the ESG investment. How does that work with leverage finance? Are you guys incorporate a lot of that stuff through the coming down from your investors down? And is it profitable? I guess.
Paul, you want to take that, or
Yeah.
I'm happy to jump in?
Yeah, it's not a huge issue right now on our leverage portfolio. It's still evolving. I mean, we are seeing it in other parts of the bank, like our project finance business, our oil
Yeah.
and gas business. But I think it's still in the early stages on the private equity side, particularly around the middle market side of our portfolio. Ken, I don't know if you have a different perspective here.
Yeah, no, I'd agree. I would say in our case, we have a head of ESG and sustainability who heads that effort for us at Churchill. We have a very detailed list of industries that are essentially off limits for us in order to comply with our ESG standards. Europe is moving fairly aggressively to what is a newer, higher standard for ESG. And so things like financing weapons, financing tobacco, financing high carbon content, industries or businesses that would be, high levels that would be producing high levels of pollution or environmental issues. The carbon index is another issue. So we have a set of screens that really govern our investment, our financing decisions. So, and by the way, we believe that those screens are ultimately good business because they are keeping us away from companies or industries that long term are going to find it more and more difficult to finance themselves. So ESG screens are very common. I would say that more recently the bar is being raised principally by the Europeans as they are looking to move to a more carbon neutral investment profile. And so pretty much all of the large private credit managers are moving to a significant commitment to ESG. Now, in our case, TIA, our parent company, is a significant investor of ours, and they've committed to carbon neutrality over the next decade. And as a result, we're on the forefront now of driving those dynamics. Now, what's different between us, for example, as credit investors and equity investors is that we don't actually control the company, right?
Yeah.
So we make a decision to provide financing, and that financing decision is based on the business that we finance. And if that business turned around and started becoming much less or not ESG focused or compliant, we couldn't just pull our loan away, right? And we have no ability to force a company to engage in ESG compliant activities. Now, that being said, pretty much all the private equity firms that we finance have ESG senior people that focus on ESG. So they're being pressured by investors to focus on it. We're being pressured in a somewhat different way to focus on it. I think that the end result is that if a business is not paying attention to things like their carbon footprint, what kind of products are they producing, they are, being blind to the realities that, we're seeing in society today. And I think it's going to continue to be, a key focus. There are a handful of funds today, credit, debt, or equity, that focused on impact or ESG investing. And I would say that that area is far more nascent, but it is growing, and I think it is going to continue to be a focus of institutional investors. But as a credit investor, it's really primarily screens, right? In other words, not investing in businesses that have specific issues, and that's primarily what's been happening. Although the bar has been getting higher and higher.
Right. So when you look at the new deals that come in, it's also another factor you look into.
Correct.
The sustainability and everything else.
That's right. That's right. We actually have an ESG checklist.
Okay.
Right? So we have a detailed checklist, and we commit to our investors that none of our deals will run afoul of that checklist.
Yeah, very good. what about you, Paul? Do you have like a specific, checklist on your application for any
We
deals?
do. We have a
Okay.
specific, yes. If I wanted to do an oil and gas deal right now, I'd need to run that through the ESG group. Yes,
What
we
industries?
definitely do.
What industries, guys, are you looking at now? I mean, of course, cyclical industry is not in favor going into this market, but what are the kind of the hot industries now you're looking at specifically, Ken? As you see on your
By the way, just as a background, I was checking with my people on SMBC, and I'm proud to say that we have quite a few financing. And in fact, Paul, our teams had dinner last night. So you see how
Yeah.
the world is connected. I mean, so well.
We're working on one right now that's going to close it later this week, I think, or I think maybe it could push to next week.
That's exactly right. So the world we live in, just as an example,
We are interconnected.
highly interconnected. So anyway, so you were asking about areas that we're avoiding or focusing on industry-wise.
Yeah, industries that you see now these days, of course, non-cyclical. What are the private equity looking at now that works for the leverage market? Like yourself. Yeah.
So I would say that industries that we are focusing on today we're very focused on a more conservative profile. So businesses that are not being impacted by the current supply chain challenges, that are not by fundamentally impacted in a major way by interest rate movements, and that have historically demonstrated an ability to pass on price increases to their end customer. All the while also looking at businesses that may have significant consumer exposure, because I think at some point, just given how hard the Fed is fighting this inflation challenge, we're likely to see the consumer start to get a little bit weary, if you will, and we'll certainly start to see, I think, some softness in the in the consumer and ultimately in consumer markets. So I would say our portfolio today is focused on areas like software, recurring revenue, business services, technology, distribution, big. And in fact, Chris, there are a lot of companies and businesses that have benefited through COVID. And I think that, those are the kind of companies that we finance. So the audience may say, well, gee, give us an example of like a company that could benefit. Well, we have been for a long time the lender for a company called Diligent. Now, Diligent, you may recognize, certainly professors there may recognize, Diligent provides a service. Their software used by investment committees, investment boards, public companies. Many of the Fortune 500 use them to disseminate board information in a very secure software, very stable platform. Well, why is that such a great business? If they're doing a great job, companies are becoming more and more complex. Their board materials, their investment committee materials. We're all familiar with a big stack of board materials that used to get distributed to board meetings and investment committee meetings. Today, all of that can be put online, accessed through optical scan, and only the investment committee, only the secure, approved individuals can actually access that information. And if you want to change the materials 3 hours before the board meeting, you can go on quickly and change. So it's, and that company today dominates the business of providing secure software communications to boards, college boards, investment committees, public companies. But a great example of recurring revenue, in a very inelastic customer from a pricing perspective, and a good example of a software business that has continued to perform extremely well through COVID and obviously to date.
Yeah, just for the audience, of course, in the leverage market, if you have a company that has strong cash flow, it has a good exit, you come out and it has growth, cash flow, and exit. It makes a good candidate, I guess, for any of those deals. So that's good. Thank you, for Ken. Anyone in the audience has any questions? If you want to turn to the audience now, do you have any questions, Josh or Jay? I haven't seen anything on the chat. Okay. I have one question here from a student. I read on the news, Wall Street banks suffer $500 million losses because of Citrix debt early this year, and banks funding Twitter also face potentially significant losses. What is the implication for the leveraged lending market or direct lenders? Could you please provide some colors for that? We'll start with Ken. What do you think?
Okay, so the easiest way to explain that to your audience is called a conveyor belt. You're familiar with a factory, and there's a conveyor belt, and the belt goes through the factory. And so these are loans that were underwritten prior to the market correction, or they were at least committed to be funded prior to the market correction. The big banks estimated that it was going to cost pricing. They estimated that they should be priced at, SOFR plus 450 or SOFR plus 500. And they structure them with a certain amount of leverage, certain amount of equity, all the things we talked about. The conveyor belt's moving. All of a sudden, the conveyor belt stops. The market dislocates, and suddenly the pricing of that loan is no longer can clear the market, right? So the big banks have underwritten the loan. It's sitting on the conveyor belt. The big banks are in the moving business, right? They're in the business of moving and selling and distributing the loans. And suddenly the pricing doesn't look very good, and it becomes very difficult to sell those loans. And so the banks ultimately make a decision that rather than keep them on their books, they're going to mark them down and blow them out effectively. Yeah. And so they take a loss, not because of the credit quality per se necessarily, but because the pricing markets and the pricing terms have changed, and the underlying structure may have changed. And at the end of the day, the pricing that could distribute that loan may now be at 94 or 93 or 92. And ultimately they get those loans off their balance sheet, but they come at a cost. The difference between that, which is a broadly syndicated loan market, and the private market is that when we do a loan, we take the whole loan down, right? Yes. So if we underwrite 400 million, we actually own the 400 million as a primary lender investor. So that's what is going on. And the banks obviously have to clear those loans out before they can start the conveyor belt rolling again.
Yeah, that's perfectly said, Ken. I know that the banks that try to put some flex language in there, try to anticipate any movements in the price, but even with the sudden movements we've seen now with interest rates and everything else, sometimes the banks have to take a loss and move on. So thanks for the question. One more question that came in and might ask for Paul. With the recession looming over, lending costs remaining high, what are your outlooks for the probabilities of default in the junior tranches? I guess it's more for Ken too, but junior tranches, what do you think? Would that take everything down if you have some defaults there? Paul.
Yeah, I think we're expecting default rates to move. I think we are going to cycle into a recession. I think the question is whether it's going to be a mild one or a more severe one. I'm obviously hoping for a more mild one. Hopefully the Fed is almost done with their rate hike cycle, and the inflation starts to moderate. But obviously the impact of that has been to slow economic activity, so it is going to come to pass. So I do think we will see an increase in default rates, and hopefully it's not going up to that kind of 4% level, Chris, that you were showing earlier.
Yeah, and I guess, Ken, because you guys are more patient through a cycle, since you're holding the whole loan, you have to sell it. I guess I'm thinking like the risk return might not work for a cycle, but over time, I guess you can manage through your junior debts and everything else if the company suffers of recession, unemployment, everything else, right?
Yeah. So, Chris, I'll make an interesting comment, because I think it's sometimes that history is a good guide or a way to think about things. So back in the GFC, Paul, I don't know if you were in your current role back in the GFC, but for those of us who were, we saw that the index for the liquid loan market trade to 70 cents on the dollar, 67, 73, whatever. all the way down. Now that would imply that there was a implied 30% loss rate for leveraged loans, liquid loans. The truth of the matter is the actual loss rate was closer to like 5 to 6%, right? So what you see sometimes in periods like now, although it's not as distorted as the GFC, what you see is that liquidity issues can drive, override fundamentals, right? And that's what happened in the GFC. What's interesting about the private market is that we value every single loan based on the fundamentals because our loans don't trade, right? So we get a third party firm to come in and just value the loan based on, is the company going to repay the loan? Is it money good? Is it performing? What's the leverage profile? Is it priced appropriately? And so our market, private market, tends to be a lot less volatile from a pricing perspective, whereas the liquid loan market can have a fair amount more volatility than that because of the need, investors' need for liquidity or otherwise.
And I guess you answered the next question.
Definitely more of a technical. Yeah, sorry, Chris. I was going to say there's definitely more of a technical factor in the large cap traded market than the private market. Definitely.
Yeah, and of course, you answer the next question. Of course, people want to see if the FX situation, FTX situation, have impact in the liquidity, everything. But that's like you said, if you're private and you're patient and you're sitting on top of the balance sheet, you're providing debt. If you're providing at the top of the balance sheet, you don't have to fear any equity movements as much.
Yeah, the fallout from crypto, by the way, the fallout from FTX has been very muted, very muted. I mean, I will say, aside from being, the fraud of our generation in terms of, what was done there, and it's really terrible in my view. The commingle of customer funds is really, really unfortunate, and obviously there's going to be a lot of investigation into that and how it happened and why it happened. But I would say that it has not had an impact on the credit markets in any material way. There are obviously some lenders who lend to crypto, but that is really not our world, and we haven't seen really any impact from FTX or the fallout. I don't know, Paul, whether you've seen it, but we haven't seen anything there.
I have not seen it. No.
Yeah, and the last question, I guess, before I think we'll get into that time, I'm going to answer another question, if that was okay. One of the students, looks like a very smart student, asking a question: are financing firms, in parentheses banks or PE, concerned over the mounting FX swap market debt, which saw funding squeezes during March 2020 and 2008 financial crisis? Any forecast of how this will affect liquid capital and FX markets next year during a recession? It's not really directly related. I could answer that question that, of course, any pressures the PE markets have and everything has some effect. But as I mentioned, Ken has made a point that all this noise around funding and everything else is it doesn't really affect, since you have investors behind all those, you control the investment, I guess, behind all the.
Well, first of all of our loans are US dollar.
Exactly.
Right. So 100% of our loans and financing are in US dollars. I would say the two principal credit markets today, loan markets, are obviously US dollar and to a lesser extent, but euro. And then maybe sterling. So sterling and euro in Europe probably represent. We don't do Europe, we don't do European deals at this point. Paul, I don't know if you guys do, but you're talking about a couple currencies. Yeah. And I would say, as a general matter, if a company's doing a US dollar deal, US dollar investors, so you're not really implicating the FX markets. In kind of corporate credit, at least not the world that I live in.
Okay, very good. Thank you.
Most of
go
ahead.
Okay.
No, go ahead. Most of our portfolio is U.S. based. We have some revolving credit where there's multiple currencies to accommodate foreign operations, but most of our portfolio is U.S. based.
Yeah, and the middle market, I guess, serves the US. Is not like you're doing a large company that has FX
Yeah.
exposure and that kind of thing. And the last
Yeah.
question, I guess, is more related to changing how does a student, and we have about 170 of them actually now on the line, how does a student goes about starting his career in credit risk management or leverage finance? Let's start with Paul. What's the process and how do they actually get there?
Sure. Obviously, the first step is an internship. So looking for a summer internship while you're in your college, starting your college career, and then working your way into an analyst program, something like we have here at SMBC for graduating seniors. And it's a 2-month program. It's pretty credit and capital market intensive. And that leads to a direct position with the bank, starting in one of a number of different functions within the bank.
And yeah, for the students, actually reach out to me and we'll find out through SMBC at least, what the process is through HR. And I think that's the concept. Ken, what about you? How do you guys approach colleges and the career?
Yeah, sure. Well, as a general matter, we tend to hire folks that have had, 2-3 years of experience working at a commercial bank or an accounting firm. And I would say, I would say those are generally very good training grounds. They have, great training programs. It's a great way to learn the fundamentals. Obviously, some folks jump right into it. But I wouldn't be afraid to go to a first-class institution, get some experience, do a couple years at a large bank or an accounting firm. They're great training grounds. And I think, generally our experience has been that folks who come out of those bank training programs or have a couple years of accounting experience end up doing very, very well in our world in private credit. We also have a pretty significant private equity platform as well. And so, we do occasionally hire folks, out of investment banks as well. So either commercial banks or investment banks. But I think that's a perfectly good way to start your career. And I would say that most of the folks that we've employed come from one of the big 4 accounting firms, particularly in some of the finance and operations areas, or out of one of the banks or the investment banks. If I look across our underwriting teams, JP Morgan, I think we may even have a couple of folks from SMBC who are a product of their great training programs. So it's a good place to start and learn the business, learn the fundamentals, and then some people stay and others find other opportunities in private equity or private credit. But it's a good starting ground. We rarely hire folks directly out of undergrad. It's usually a couple years experience at a bank or an accounting firm or investment bank.
It's funny you said that. It's like I used to hire all these guys out of school, train them, spend money on them, and after 3 years they moved to Churchill, I guess. So, so thank you guys. I appreciate your time. This is excellent. Thanks for the audience and listening into this. These are the guys that they make decisions every day on the credit side. So appreciate your time, and thank you, Ken, and thank you, Paul, for being there to answer any questions. Thank you very much.
Thank you. Well, thank you, Chris. And
Thank you.
my daughter is did a couple years at Columbia, so she's an alumni, and very, very grateful for the opportunity to do this. Appreciate very much.
Thank you, guys. Thank you, Paul.
Thanks, Chris. Thanks for thinking of me for this. It was very nice process. Thank you.
Thank you,
Thanks,
guys.
Paul. Thanks, Chris.
Thanks.
Thank you.